Hello and a warm welcome to Tideway Live and today's programme on investing in hybrid capital. And we're broadcasting live from the London Stock Exchange studios. My name is Nadine Dereza, and throughout the next 30 minutes or so, I'll be interviewing Peter Doherty, who's Chief Investment Officer and Managing Partner of Tideway Asset Management, and finding out about his approach to investing in hybrid capital markets, as well as looking at what exactly hybrid capital is and what it does. We'll also explore why companies choose to issue hybrid capital, as well as the opportunities and the potential risks involved. Of course, we'll also be talking about the Tideway Hybrid Capital Fund, one of the UK's top performing strategic bond funds. And thank you very much for sending your questions and comments in advance. These have really helped shape the programme, and they're going to form the basis of my interview with Peter. But please do keep sending your questions and comments in throughout the live broadcast, and I'll try and get through as many of your questions as possible. All you need to do is type the question into the box and then press the submit button. And once the programme has concluded, if you require any further information, you can email the Tideway Asset Management team using the funds@tidewayinvestment.co.uk email address, which is shown at the bottom of this page. So, Peter, welcome to you. Thank you for joining the programme.
Pleasure.
And first of all, to set the context, what exactly is hybrid capital?
So hybrid capital is a debt instrument. Imagine a capital structure. At the top you have corporate bonds, traditional corporate bonds or deposits, the most senior liability of an entity. At the bottom you've got equity. We're in the middle of the balance sheet, so we're somewhere between senior debt and equity.
And who actually issues hybrid capital?
Well, the good news is hybrids are really issued by large, well-capitalised household name companies. So you could pick people like National Grid, EDF, Aviva, Legal & General, and then, of course, the banks. So you're in typically investment-grade companies. You may be down the capital structure into a sub-investment-grade bond, but the issuer itself is a well-known investment-grade company.
And why do companies actually issue hybrid capital? What's your thoughts on that?
A couple of reasons. One is, depending on the industry, it could be for regulatory capital reasons. So if you look at the banks and insurers, they have a very well-defined, clean set of frameworks where they can issue capital in the hybrid space. They get an equity contribution from that, and same thing for the corporate space. So it's about getting equity or an equity component from a bond, and that's due to the terms and conditions, without issuing common equity. So it's a way to run a slightly more leveraged balance sheet.
So to bring it to life as well.
Yeah. So in addition to that, so the issuers get they get tax deductibility on the interest. So it's a way of really creating low cost on an after-tax basis for equity.
So that's the theory.
Yeah.
So let's go to the practical now, and it'd be great for you to share some examples, ideally from a variety of sectors. So let's sort of hone in on the corporate sector first of all, so we can bring hybrid funds to life.
Sure, exactly, yeah. So a name that we like in the hybrid space, and not necessarily from equity space, we can talk about how that can differ, but we like Sainsbury's, for example. So FTSE 100, £5 billion company. They issued a hybrid in the middle of 2015. The terms and conditions of that we think are quite favourable. The bond is callable 2020, so it's a 5-year risk. If they don't call the bond, the coupon steps up to about 9.7% over 5-year gilt, so about a 10% yield. Sainsbury's doesn't need to fund itself at that sort of level, so the bond will get called. The 6.5 coupon over those 5 years, it's a deferral only, so if they don't pay, you've got to pay back at some other point. There's a dividend stopper, so that if they miss the coupon, they can't pay a dividend. Sainsbury's is a regular dividend payer. So we think the risks of that bond not paying or having an issue is quite small. Would we necessarily want to own Sainsbury's equity? Not necessarily, but in terms of a credit perspective, are Sainsbury's going to meet their obligations? Is it a well-run business? Yes, it's fine.
So in terms of any other examples, have you found a business that you thought, actually, that looks potentially exciting, but then when you've done your due diligence, you've decided to pull away?
Yeah, so one great comparison is in that retail space. So around the same time that Sainsbury's issued the 6.5 perp, New Look issued a senior unsecured 7-year bond, also with a 6.5 coupon. So this is not being sort of clever with the hindsight mirror. We said at the time, would I rather own subordinated Sainsbury's or senior New Look, and our strong preference is to own sub Sainsbury's. Those bonds have done very well. The New Look's had a very challenging time, and those bonds have gone down a lot. But in general, I think our whole thesis is that owning more risky securities from less risky balance sheets is much better than the other way around, and that's what we like about the hybrid space as opposed to the traditional high yield market.
Okay, so that's great examples from the corporate world. How about from banking and insurance?
Sure. So in insurance, there's a wide range of opportunities. Insurance is about half of the hybrid market. I'll give a couple of examples driven by regulatory change. So Old Mutual is a name that we've liked for a long time. They've had disparate businesses, US asset management business, South African business, and UK. Under the old regime, sort of pre-Solvency II, they were allowed to say, well, we have lots of capital as a group, which is true. Under Solvency II, that capital isn't fungible. So what that means is that in a time of stress, Old Mutual couldn't say to, the South African business, can you send us some capital? It's unlikely that the South African regulator would be able to do that in enough time. What that drove for Old Mutual was a business review that then has allowed them to sell off various parts of the business and deleverage. So at the end of 2015, so only 2 years ago, they issued a 10-year fixed-term hybrid capital note, 7 7/8 coupon. We've just tendered that bond. There was a public exercise for them to buy that back and deleverage. But that's at 125. So what's very interesting about that is that we've lent money to a £9 billion business for 2 years. We've made 2 years of 7 7/8 plus the 25. We've made over 40%. So we haven't had to go into super illiquid, very exotic securities to make very high double-digit returns.
Now, Peter, everybody wants to beat inflation. So how can you beat inflation with a hybrid capital fund?
Sure. Okay. So if you look at the world we're in now, you've got QE and low nominal rates, which are low, even lower of negative real rates, of course. If you look at traditional corporate bond funds and then corporate bond ETFs, they're going to struggle to deliver inflation. That's put a lot of money, obviously, into less liquid assets, which can be fine. It's also driven a lot of money into equity income funds. We think that hybrid capital, that middle space, is a terrific place to be. You can be in a sort of medium-term duration, so 5-6 years. Most hybrids are still in that sort of 4 to 6% return target, and we can describe, how we can get more returns in the early years of those bonds. So there really is a capacity to deliver that 5-6% return long term, and we think that's a very good place to be.
And even though interest rates are low, they are looking like they're going northwards. We've seen a rate rise here recently as well. Does that still hold true, what you've said then?
Yeah, I think the way we look at it is we look at the life of a bond and what the total return available is over that life. Now, when that comes is another matter. So in recent times, you've had stable or falling rates. And obviously, people are prepared to pay up for short-term security. So I'll come back to the Sainsbury's example. That bond's had a 6.5% return, will have over 5 years, a sort of 32.5% return. But we've actually had about 22 of that in the early years because the bond's gone up to 109. Now, what that means, of course, we don't have a magic money tree at Tideway, unfortunately. So that means that the future years, the remaining 3 years of that bond, are going to be around a 3.5% return. So that's really where you are. It'll come in sort of different spaces. But the main thing is, if you start with your portfolio in that sort of 4 to 7% baked in returns, then when it comes, you can manage that and you can deliver those consistent returns. Yeah,
it'd be great to get a sense of how big is the sterling hybrid capital market.
Yeah, well, it's interesting because when you describe it and you go through things, people haven't necessarily heard it in that guise, but people do understand certain securities and certain names that are in the market, but the market is somewhere between 60 and 70 billion pounds, and so that really allows for funds to grow to that sort of 500 million to a billion pounds.
And that's based on what, 2016, 2017 figures?
2017 figures, yeah.
And how does that compare with the global market?
So the global market, obviously, you've got euros and dollars are the two other big currencies. There are some other currencies issues outside of that. But in broad terms, the global hybrid capital market is about £600 billion across the different currencies.
And we've had a few questions sent in advance around how does the hybrid capital market work and who can get access to the bonds.
Yeah, so that's something we spent a lot of time working on at Tideway. So there's a number of different moving parts. One is that many hybrids used to have small denominations, 1,000, 5,000, 10,000. It was a market which many retail investors could access. That has sort of gone away. Most new issues are now 100,000 or 200,000 minimum denominations, which is actually why we created the fund to unitize the market. Getting access means having a credible story that you're a long-term investor. So we meet the companies, we meet the management teams. We're on the roadshow. We have meetings with management teams outside of a roadshow. But then we also tell our story into the sell side. The sell side have the relationships with the issuers. We explain. We're a dedicated hybrid capital business. We have a dedicated fund, and then we have our own research team. So we provide all of that work for our own benefit. Then we'll feed back to the issuers and to the banks and say this is where we would have interest. So we're not quite big enough yet to be a price maker. We're a sort of price taker, but we're in that sort of cost where actually people do care what we think.
And one question that's just come in over the last few minutes is actually the duration of a hybrid capital fund. So is there a set duration?
Yeah, so in this fund we target the sort of 5 to 6 year area. And as part of our wider portfolio approach for clients, we think that's a nice place to be. There are some very long duration hybrids, which there's nothing wrong with those, but they do have obviously a higher sensitivity to interest rates. At the short end, you're competing with other buyers who are probably less price sensitive. So in that middle range, we think that gives a nice mix of not too hot, not too cold.
And from all the people I've spoken about, it does seem like a very specialist market. I know there's not many people in this space, but I'd be curious to know how much research Tideway Asset Management actually does when it comes to hybrid bonds. So what efforts are you putting in so that you truly understand the marketplace? Yeah,
well, actually, our research efforts have been incredibly successful, specifically in unrated bonds. That's where you really have to do your homework. So many credit funds, many bond funds are set up with a rating constraint or rating sort of guidelines, and that's okay. But you are relying quite heavily on third parties to do that research. Now, obviously, rating agencies have had good periods and bad periods about how their ratings have correlated with the actual risk in the assets. And so we have our own team of CFAs. We're doing detailed bottom-up research. We're meeting the companies. We go through the balance sheets. We have the models. And this year, in fact, some of our best returns have been where we've worked with an unrated company who've then, or looked at an unrated company, and then we've actually seen them transform to a rating. And usually what happens is, people get a rating because they think it's going to be quite a good one. But at that point, we've had a significant jump in the bonds, and that's something that we think is an ongoing process. So having an unrated bucket in the portfolio is very important for us.
And how seriously are you taken by senior leadership teams of, say, the corporates, the banking, insurance world? Have you got a seat at their table? Are you getting the inside information?
Yeah, we're not getting any inside information. We're getting public information at the right time, just to be clear.
Well corrected.
Exactly. But no inside information ever. No, what we're getting is this year there's been a number of let's take Society of Lloyds, for example. Great institution. They have their own capital structure. They have their own hybrids. We met their management team alongside the world's biggest investors, and we participated in that bond. So you can pick any of the big hybrids issued this year in the sterling market, and we've had a seat at the table, and we've given feedback. We're alongside everybody else.
So, and you see that process going forward? Do you
it's great for us, yeah.
And are you getting asked for advice as well at the moment by them, as well as to, how to structure these things? Yeah,
I think we give feedback on pricing, and we give our range of preferences. The interesting thing for us is, post-Solvency II, we'd love to see more RT1 or Tier 1 risk coming out of the insurance companies, but they're actually making so much money and have done such a good job of preparing for Solvency II, they don't need any capital. So we try and feedback regularly. We've seen a number of businesses that we think have slightly stressed balance sheets, but could pay down debt generally, and we'd like some of those to issue hybrids. In the same way that Sainsbury's did, actually. So, yeah, we'd love to see more of those.
Well, so far, very positive about hybrid capital, but there's got to be some risks involved. Yeah. So, when it comes to risks in investing in hybrid capital, what are they?
Okay, so I did write a guide to hybrid capital earlier in the year, and in that tried to show a very clear picture that if you'd bought a portfolio of hybrid capital prior to the financial crisis, you would suffer a very severe markdown in prices. There's no hiding away from that. These instruments do behave like equities on the way down in some cases. But so therefore, it's all about managing that risk, managing that part of the capital structure that you're in. If you're in a more senior hybrid where you've got deferral only, you've got a fixed end date, then you're going to get less volatility. If you're down into the tier 1 space, there'll be more volatility. Of course, in the banking system, which is it's seen the biggest change in the past 5 years, over the crisis, it was realized that you had really socialization of losses and privatization of profits. Instruments that were previously called capital or hybrid capital didn't really have a loss-absorbing mechanism. So one of the phrases that's been used in the past couple of years is, what's the loss-absorbing mechanism? What that means is that people like us, we have a much higher probability and a much earlier probability of taking losses in the cycle. The famous and the sort of headline instrument in that space is the COCO, the contingent convertible. Now, it's slightly strange, I think, that you can go and buy as much equity from Lloyds or Barclays or anybody else as you want to, but you can't buy a COCO as a retail investor, but that's what the FCA has said. So one of the key attraction thing about fund is that we have a COCO allocation. Now, we can't buy the entire market because we have our credit rating constraints. We're only buying BB bonds, and even split-rated bonds. We're not buying a single B, BB split. But the point is, the COCO market is an interesting market. It is a market of opportunity, but also a market of severe risk. And in the next financial crisis, I guess there will be one sometime, those bonds may convert into equity, or in some cases actually get written down. So I think it's a long answer, but I think the point is that it's a professionals market. You've really got to understand the terms and conditions of every single issue. You've got the credit risk of the institution, but you've also got the terms and conditions of the bond and what's going to happen to you in a bad time.
Now, you've already discussed the size of the sterling hybrid capital market. Obviously, Tideway Asset Management has its own sterling hybrid capital fund and is currently one of the UK's top performing strategic bond funds. So one of the questions we had in, it says, what does it do and how is it structured?
Sure. Well, I think the interesting thing is, if you look at the way the fixed income market is categorized in the UK, it's a little bit hard for investors to maybe understand what's in each fund. So a high yield fund has to have more than 80% of its bonds sub-investment grade. An investment grade fund has to have more than 80% of its bonds investment grade. In the middle, you've got this gigantic swarm called the strategic bond sector, and there are about 90 funds in there, and they're very different. My feeling was, many of those funds are trying to do too many things, right? You've got a bit of duration, you've got a bit of high-grade credit, low-grade credit. Our view is, let's specialize in one area, let's become an expert, let's do the work, do all the hard yards, and then people can take that or not. That's really, so it's a dedicated fund. So the one thing is, it's a sort of no-holds-barred, pure hybrid fund.
Now, there's a slide that we prepared earlier that we're going to show, actually, which looks at how you structure your fees and things.
Yeah. So I think the important thing is, and this is, again, I think we're not in a downturn and we're not in a stress position, but in a world of more stress, it is smaller companies that are more leveraged with worse credit ratings that will do worse. Now, in our fund, we've done incredibly well this year. We've generated about 18%, and we're at the top of the strat bond rankings in terms of performance. But that's without taking anything below a BB risk. Now, there are opportunities. Some bonds have done even better, some single Bs and some triple Cs, but that's not for us. So what we want to do is do the work on the credit institution or the issuer. Pick the right bond, pick the relative value across the various securities from a name, and then manage that general sort of picture. So it's we have a 6-year duration at the moment, but that's 6 year of credit duration. So that's why we've had sort of strong performance as the market has tightened. Now,
how has the Tideway Sterling Hybrid Fund actually performed since it was launched?
Yeah, it's done well. I mean, I think if you look, there's lots of challenges with launching a fund, particularly usage. You have a pretty high cost base generally, so we've had to absorb that as the fund has grown. The fund has grown from, I think, 3 or 4 million on the first day. We're about 60 million now, and that's starting to get money from the outside, and I think that could be a very large fund in time. But we've done well. I think we ended up in a sort of high 98, 99 area at the start of the year. The NAVs now are close to 116. On the income side, these are offshore funds. We have a quarterly dividend paid gross, and that's been around the target income of 5%. So I think we can see how the 5% net income is going to get met. We can't forecast the future. We're not macro investors. What we tried to do is make sure that the risks and the reward and the fund are balanced, and that's balanced in a number of ways across geography of issuer, type of security, industry, and a range of different metrics.
And how about the credit risk in the fund? What do you see it as being?
Yeah, look, I think there's quite a lot of credit risk in the fund. I mean, that's undoubted. But I think I wouldn't put credit risk possibly as the biggest single risk, in the sense that it's more of a systemic picture. So, do I think L&G, Zurich, Aviva, Sainsbury's, those names, are they going to meet their obligations? Yes. But if you have a systemic stress situation like the financial crisis, you're going to end up with bonds that are marked down heavily. It's a bit of a balance. I think if you have higher yields from bonds that are stressed, then you're going to be investing at higher returns. So it's not all about just wanting the bond to go up all the time. In a stressed market, we see more opportunities.
And how about the regulators? What's their view on the hybrid capital markets?
Well, the great thing is, I mean, hybrids is a well-established and go-to market, and the regulators like it. I mean, the interesting thing about the cocoa market is, which took a while to get there, but it sort of shows that, even in a world of everyone trying to do the right sort of squeaky clean thing, you have really what is an equity-like security, but you're getting tax deductibility on the interest. And a couple of governments in the Eurozone who had to pass that legislation said this is looking a bit strange. But the point is, in the cocoa market, if the banks only had to issue common equity to meet the new regulatory standards, then there wouldn't be enough capital. So to make those debt-like instruments with that risk-sharing burden, that's an important part of the market. And
because of that, do you think hybrid capital markets are going to be around for a long time?
Yeah, absolutely. Yeah, in fact, if anything, it's going to grow. So if I look at the UK, there's obviously been the big shift, and I think yesterday you got the Bank of England stress test showing that the banks are good even in a hard Brexit scenario, which may be off the table this morning. But the important thing is you've got another shift coming, which is the Vickers ring fencing. So you're going retail investment banking. The great thing about that is there'll be loads of tenders, loads of renew issues. Over the next 2 or 3 years, there'll be a lot of new opportunity in hybrids in the UK banking sector.
I don't think I've ever heard it referred to as Vickers ring fencing, so there you go. That's a new one on me. I think I might quote you on that one. Curious to know why no other fund manager has created a dedicated hybrid capital fund. I mean, why is that?
Well, there's a couple of niche European hedge fund type investors who've done things in hybrid space. There are some credit funds that are heavily invested in hybrids. But I think for us, it was important to make that message clear that it's dedicated. We're not fiddling around the edges with various things. We'll do our best to pick a secure portfolio of hybrids, and that's that. I mean, one thing is it's quite a specialist market, and I like it, but I don't know why people haven't done it. We like it.
And we've had a couple of questions in, which someone sent in earlier as well, which pretty much covers the same topic about what role does a hybrid fund have in an investment portfolio? Sure,
well, that can change at different times. I think at the moment you've got, we come back to the QE point, and we've seen portfolios from many different places, but a large part of that, that low risk, secure part of the portfolio, people used to just say, well, I'm an equity guy, I'm going to buy some bond ETFs or some government bonds. And that no longer is low risk. I mean, you're actually allocating negative real returns to people even before any fees. So you've got to find your secure income ahead of inflation somewhere else. So I think if you want to take more risk, but not too much risk, get out of those low-yielding negative real return assets and buy hybrids. At the same time, if you've got enough equity income, then what do? Instead of buying more equity income, you can buy hybrids. So you can de-risk a little bit, or you can increase risk. So we're in that, call it the Goldilocks part of the portfolio.
Now, my next question, I think this is one you're going to like, actually. It's about active beating passive when it comes to fixed income. So why would you buy this fund instead of a bond ETF, so exchange-traded fund?
Yeah, so I wrote something last month about the I think the misattribution of passive versus active in terms of why it's done better. So take the S&P 500. There's obviously lots of studies around the fact that passive S&Ps and Vanguard, they've all beaten active managers. But if you look behind that, a lot of it's about skew. So it's a market cap weighted portfolio. If you're outside the top 10 or 15 names, it doesn't matter if you do an incredible job investing in S&P 500 company number, 300 to 400. Nobody cares. You're not going to generate extra return. That skew doesn't exist in the bond markets, in the bond ETFs. So if you look this year, I to say, but the performance of the iShares 0 to 5 and then SLXX, I mean, they're quite derisory. I mean, they are in the sort of 60th and 75th out of 90 funds, and they're never going to catch up. it's not just skew, it's about new issue allocation. We talk about accessing the market and the constraints that those portfolios have around putting certain bonds in. And then finally, you've got another feature. Again, if you imagine the S&P or the equity index passives, they can create and redeem very cheaply. There's a whole stat arb market out there that doesn't exist in the credit markets again. So people who are creating, redeeming ETFs, they're paying away a bit off a spread. It's an ongoing daily frictional cost. Okay, that's 3 reasons.
And finally, what can intermediaries expect from the funds going forward?
Well, I think it's a different space. I mean, one risk which I do appreciate is the fact that an intermediary's got to explain the fund to their clients, and it's not necessarily the most straightforward space. But I think it's really important to understand that buying traditional corporate bond funds, traditional corporate bond ETFs, that's not a low risk option anymore, and gilts are pretty much off the table for the foreseeable future for protecting returns after inflation. So we think we can deliver consistent returns ahead of inflation after fees. That's the job.
Thank you very much, Peter.
Sure.
Well, we're nearly at the end of our live broadcast from the London Stock Exchange studios. Thank you very much again, Peter, for sharing your knowledge, your expertise and insights into investing in hybrid capital. I'd also like to thank you, the audience, for watching and also for sending in all your questions and comments throughout, which really helped shape the programme today. And apologies if I didn't manage to ask your particular question. Time just got the better of us today. Now, if you require any further information about the Tideway Hybrid Capital Fund, then you can contact the Tideway Asset Management team by emailing them at the address, and I'll remind you of that address again. It's funds@tidewayinvestment.co.uk, which is shown at the bottom of this page. You should also be able to see a link that says Find Out More. Now, if you click on that link, you'll be able to download the Tideway Asset Management Guide to Hybrid Capital, which Peter wrote, which will give you plenty of useful and more detailed information about this subject we've talked about here today. So from both of us here today, thank you again for watching Tideway Live, Investing in Hybrid Capital. Until next time, thank you and goodbye.